Welcome to the Financial Rundown, where I share key financial updates and insights you need this month. We'll start with quick practical tips to help you stay on top of deadlines and opportunities. Then we'll dive into bigger topics about the markets and economy to give you a clearer picture of what's going on and what it means for you. Let's kick things off with something that's top of mind for many Canadians right now: RRSP contributions. Don't worry, tariffs are later. If you haven't made your contributions yet for the 2024 tax year, the deadline is coming up fast, March 3rd, 2025. A lot of people leave this until the last minute, but tax planning isn't something you should rush. So today, let's break down the key things you need to know about RRSPs, whether you should contribute, and how this could impact your tax bill and retirement savings. If you're new to investing or tax planning, let's start with the basics. An RRSP, Registered Retirement Savings Plan, is one of the most powerful tools Canadians have for building long-term wealth while reducing their taxes. RRSPs offer tax deductibility. Contributions lower your taxable income for the year. They offer tax-deferred growth. Investments inside the RRSP grow tax-free until withdrawal. But be mindful of your contribution limit. So 18% of last year's earned income, up to a maximum of $31,560 for 2024, plus any unused contribution room that you carried forward from previous years, would be the maximum you could put in any one given year. So, should you be making an RRSP contribution this year? Let's look at who benefits the most. Well, first off, high income earners. If you're in a high tax bracket, an example may be making over $100,000 per year. RRSP contributions can significantly lower your taxable income. The higher your tax bracket, the bigger your refund. As well, people expecting a lower income in retirement. So you're working right now, and in retirement, your taxable income may not be as high. RRSPs work best when you withdraw them later at a lower tax rate. If you think your taxable income will drop in retirement, you'll benefit from the tax deferral while you're working. Also, those planning for a big purchase with the first-time homebuyers plan. First-time homebuyers plan certainly has some more intricate details to it, but you can borrow up to $60,000 from your RRSP for a first home purchase, tax-free, as long as you pay it back over 15 years. Finally, people without a pension plan. If you don't have an employer pension, an RRSP is one of your best bets for retirement savings. On the flip side, there are cases where an RRSP contribution might not be the best move. Lower income earners. If you're in a lower tax bracket now, saving your RRSP contribution for later when your income is higher might make sense. Let's say you're starting out at a new job and you're planning on working your way up the ladder there and making more money as the years go on. It may be more beneficial to delay contributing to the RRSP until future years when your income is higher. Consider using a tax-free savings account instead in the meantime, which gives you tax-free growth and tax-free withdrawals. Secondly, if you expect to be in a higher tax bracket in retirement, if your future income sources, your pensions, potential rental income, or dividends you may receive will put you in a higher tax bracket later, RRSP withdrawals could lead to more tax. In that case, diversifying with a tax-free savings account or non-registered investments might be better. A good rule of thumb here is if you're currently in a high tax bracket, RRSPs can be a smart choice. If you're in a lower tax bracket, tax-free savings account might be more beneficial. However, everyone's situation is different, so it's best to consult with a financial planner to determine the right approach for you. If you're looking to make an RRSP contribution, the next big question is how much? Start with your tax bracket. If you're in that $100,000 plus annual income range, contributions could mean thousands in tax savings. Consider a lump sum contribution versus a monthly contribution. Lump sums are great for tax planning, but automatic monthly RRSP contributions, they help smooth out market volatility and take advantage of dollar cost averaging. Think about your carry forward room. If you don't need the tax deduction this year, you can contribute and defer that deduction for a higher income year, as we were just discussing. One quick warning here, over-contributions can get you in trouble. Always double-check your RRSP room on your CRA My Account or your last notice of assessment. A few RRSP strategies and tips for you before the deadline. Well, first off, use your tax refund wisely. You can reinvest it into your RRSP for future tax savings and future benefits. You could put it towards any outstanding debt you have to pay that down, or save it into the tax-free savings account to grow your investments tax-free. Another strategy would be to consider splitting contributions with a spouse. If one spouse earns significantly more, consider a spousal RRSP for further tax efficiency. Another great tip is don't just save for taxes. Don't just put that money in the RRSP to get that refund. Invest. Holding cash in an RRSP doesn't grow your money. Consider ETFs, mutual funds, or stocks to help grow your money over the long term, of course, aligning that with your risk tolerance, time horizon, and overall investment goals. Finally, talk to a financial planner. If you're unsure about your strategy, book an appointment before the deadline to run some numbers together. Bottom line, RRSPs are one of the most powerful tools for tax savings and retirement planning, but they're not one size fits all. Take a look at your income, your future tax situation, and whether an RRSP contribution makes sense for you. If you're not sure or if you want a second opinion, now's the time to book a quick review before that March 3rd deadline. Let's make sure you're making the right move for your finances this year. Let's talk about something that could hit your wallet: tariffs. You may have heard that the US is slapping new tariffs on Canadian goods, but what does that mean for you? Are prices going up? Will this affect your job, your business, or your investments? Today we'll break it down in a way that makes sense, without the economic jargon. All right, let's strip this down to basics. What is a tariff? Think of it like this. A tariff is a tax on imported goods. If the US puts a tariff on Canadian steel, it means American companies have to pay extra to buy that steel from Canada. That extra cost usually gets passed on to the final buyer, businesses and everyday consumers, meaning higher prices. But here's an important detail. The tariff isn't paid to Canada. The American company buying the Canadian steel pays the tariff to the US government. Essentially, it's an added tax that increases the cost of doing business for American businesses. Governments use tariffs for a few reasons, but the biggest one is to protect their own industries. If Canadian products become more expensive in the US because of tariffs, American companies suddenly look cheaper, and people are more likely to buy from them. But the ripple effects go way beyond just business-to-business deals. It impacts jobs, product prices, and even the stock market. So why is the US imposing tariffs on Canada? Well, Trump is back in the White House, and as expected, he's making moves on trade. Even though we have a trade deal that was renegotiated during his last term, the United States-Mexico-Canada Act, he's arguing that Canadian industries are hurting U.S. businesses. To fix that, he's bringing tariffs back. The United States is currently discussing the imposition of tariffs on Canadian goods, particularly steel and aluminum, citing concerns over national security and the need to protect domestic industries. The proposed tariffs include a 25% duty on steel and aluminum imports from Canada, set to take effect on March 12th this year. The U.S. government argues that these tariffs are necessary to support American producers who are struggling to compete with imported goods. However, such measures can lead to increased costs for U.S. businesses that rely on Canadian materials, potentially resulting in higher prices for consumers. In response, recently resigned Canadian Prime Minister Justin Trudeau has condemned the tariffs as unacceptable and has indicated that Canada will respond strongly if necessary. But it's important to note here that trade negotiations are ongoing and the situation remains fluid. Both nations are engaged in discussions to address these trade issues and mitigate potential economic impacts. So let's see how this actually plays out in real life. Let's go through a simple example on how tariffs may impact your everyday life. Step 1, a U.S. car manufacturer needs steel. Let's say Ford in Detroit wants to buy steel to build cars. They have two options: buy steel from Canada for $1,000 per ton, or buy steel from a U.S. producer for $1,200 per ton. So now step 2, the U.S. imposes that 25% tariff on Canadian steel. What happens now? Now, Canadian steel doesn't cost $1,000 per ton anymore. Ford has to pay an extra 25% tariff, or $250 more per ton in my example, which goes to the US government. That means Canadian steel now costs $1,250 per ton, which is more expensive than US steel. Step 3, Ford chooses US steel instead. Since US steel is now the cheaper option at $1,200 per ton, Ford decides to buy American. That's a win for US steel makers, but bad news for Canadian steel companies who now lose customers. And you could picture this happening across a wide variety of Canadian industries. Step 4, the costs get passed down, but Ford's cost of making cars just went up because steel is more expensive everywhere. So when you go to buy a new car, the price is higher because manufacturers are paying more for materials. That's how a tariff hits your wallet, even if you don't work in steel. And as I said, this same story plays out across industries: construction, electronics, groceries, because tariffs create a domino effect. And it's not just Canada. Trump has also slapped a 10% tariff on all Chinese imports. This is a big deal, especially in the tech world. Tech and chip makers that may be affected are companies like Apple, Nvidia, and Tesla that rely on Chinese manufacturing for components. A 10% tariff makes their production costs higher, which means more expensive tech products for consumers. If you're in the market for a new laptop, phone, or EV, you might see prices rise. The stock market reactions to trade wars and these tariffs could cause volatility in tech stocks. If you own investments in big tech, expect short-term market swings. So whether you're looking at higher costs for your next iPhone or thinking about your investment portfolio, these tariffs have real-world consequences. What are the big banks saying? Well, while the U.S. has recently imposed tariffs on Canadian goods, many analysts believe these measures may be temporary. For instance, Goldman Sachs suggests that a more short-term implementation of tariffs would result in a smaller impact on stock markets. Similarly, JP Morgan advises investors to focus on long-term strategies, implying that current trade tensions might be short-lived. And these perspectives indicate that the current tariffs could be part of a politically strategic negotiation process and may not persist in the long term. So how do we protect our finances during these uncertain times? Well, from the consumer's point of view, you should be mindful of rising costs on big purchases, especially cars, appliances, electronics in particular. In addition to that, if we can buy local products when possible to avoid those potential price spikes on imports by taking an extra minute while we're at the store to look and see if it's made in Canada or made locally, that can help keep more money in your pocket during these uncertain times. From an investor's standpoint, diversification is king as always, but more important in this situation. Diversify your portfolio. Don't have too much exposure to industries that may potentially be affected by tariffs. Watch out for market volatility, especially in manufacturing and tech sectors. Look for opportunities in historically more tariff-proof industries, sectors like healthcare, utilities, and essential consumer goods that tend to be less affected by the trade disputes. Allocating some investments in these areas can help balance your portfolio. Bottom line here, tariffs don't just affect governments and big companies. They affect all of us. Whether you're a consumer, business owner, or investor, these policies can impact your costs, your job, and your financial future. If you want to discuss how tariffs might impact your personal finances or investments, now is the time to plan. Let's take a look at where you might be exposed and come up with strategies to keep you protected. As we always do here on the show, let's wrap up with a few of my recommendations. The latest book I'm reading is the 5 Types of Wealth, a transformative guide to design your dream life by Sahil Bloom. It challenges the old school notion that wealth is just about money. And here at Philotimo Wealth and myself personally, we believe the same. Bloom breaks it down into 5 key pillars. The first pillar, time wealth, prioritizing and managing your time to focus on meaningful activities, which leads to the second one, social wealth, building and nurturing deep, meaningful relationships, which I think can help with your mental wealth, the third pillar, and kind of cultivating a mindset that fosters purpose, clarity, and continuous growth. The fourth pillar, physical wealth, maintaining health and vitality through proper movement, nutrition, and rest. And finally, the last pillar, of course, financial wealth, achieving that financial independence, but more importantly, defining what financial sufficiency means for you. True wealth isn't just about money, it's about balance. Aligning these 5 pillars with the life you want to live is what truly matters. And a quick tip, as I love to listen to audiobooks and podcasts, I think a great hack is changing that setting and listening at 1.25 times speed, or even faster depending on the narrator. You'll get through more content in less time. Now, I'd love to hear from you. What podcasts are you listening to? What books, shows, or movies are on your list? Let's keep the conversation going.